Hey everybody, Justin Walsh here, branch manager with Franklin Direct. Recording a video today on some very interesting ways that equity can be used to generate wealth for a homeowner. Anyone watching this video is probably aware by now there's more equity with homeowners than there's ever been. Values and the real estate market has just continued to climb over the last several years, and combined with interest rates being at historical lows. So you have this combination of two things, with values being extremely high, interest rates being extremely low. And there is opportunity out there for homeowners to take advantage of those things to help generate more wealth, more cash flow for later on in life. So we're going to cover a couple of those topics. And I will preface this by saying in this video, one size does not fit all by any means. I am not a certified financial planner by any means, but I am someone who is mature financially and does understand and enjoy communicating these topics to folks, because there is a lot that can be done or not done when it comes to your equity. So jumping right into this, we have an example here, a homeowner that has a home worth about $970,000, and they currently owe $384,000 at a rate of 3.125. They're in a 30-year loan, and their payment is just over $1,700 per month. Okay, and this homeowner is opting to take a new loan of $590,000. I just kept their rate the same just to be really conservative in the numbers that I showcase here. And they would be taking $200,000+ in equity out. And because their loan amount would be going up by $200,000, their payment would also be going up to $2,527 per month. Okay, so that's an $813 increase in the payment. And I want to show what this $200,000 in equity entails, how much more it's going to cost, and what can be done in this low rate environment with this equity to help generate that wealth. So going over the bad first, we already talked about how this would come with an $813 payment increase, and that would equate to $125,000 more in interest being paid by this homeowner over the course of 30 years. Okay, so taking that money out, they will pay an additional $125,000 in interest. Okay, now what are avenues that can be taken with this $200,000? Okay, we know the rate is 3.125. For most homeowners, they are able to get some of this interest that they pay directly back in their tax deductions. For anyone that itemizes their interest on their taxes, a portion of this is recoverable, so we know that. Okay, and the first thing I'm going to show, what happens if this homeowner takes that $200,000 and places it into a long-term investment account. Okay, so down here you'll see a $202,000 investment. Okay, so putting all $202,000 into an investment account, making an average rate of return of 8%. Mind you, folks watching this, the S&P 500 in the last 80 years has averaged over 9% return. So we're using 8% for the example in this video, and not contributing a single dollar again. So this would be an initial investment, and that's it, at an 8% return. Over a 30-year duration, that initial investment of $202,000, if left in place for that entire 30 years, would equate to a $2.2 million asset 30 years from now. Okay, I showed everyone on this video, this exact loan would cost $125,000 more in interest, but that pales in comparison to the potential account balance in a 30-year investment, okay, with an 8% return. And really, financial 101 here. This homeowner would be borrowing $200,000 at a rate of 3.125, a portion of which is typically tax deductible for higher income earners. And that money that they're borrowing at 3.125%, if they're making 8%, they're making significantly more than what that money is costing them and creating wealth by using equity. And for clients that I talk to on a day-to-day basis, the most important thing to understand, money that sits in your equity as a homeowner, it does not make you any money in return. Okay, how much equity you have in your home does not prohibit your home value from going up, right? Whether you owe 500,000 on your home or 300,000 on your home, that does not factor into your home's appreciation. Your home will still go up whether you owe zero or whether you owe $500,000. And that money that's sitting in your equity, it makes a 0% return. It's just sitting there. And it's only accessible if and when you sell or if and when you take out a loan. The other thing many homeowners endure or are going to face in the coming decades, equity can be very difficult to access in a higher rate environment. Okay, doesn't mean that's going to transpire, but let's say rates are at 5, 6, 7+%, and a majority of that homeowner's wealth is tied up in their equity. The only real ways to access that money is through an expensive loan at higher rates, through the sale of that property, or through less favorable products like a reverse mortgage. Okay, as opposed to taking equity out in a lower rate environment, investing that money into a conservative but long-term account, this money that's invested, that's easily accessible to that homeowner for emergency purposes, later in life expenses, and it can be significantly easier to touch and use that money as opposed to equity. Okay. The other example I'll provide is I just showed you a long-term investment account, but let's say that same $200,000 was used to buy a rental property. Okay. So this rental property, let's say they bought a $650,000 investment property with a loan amount of $450,000 at an interest rate of 3.25. Okay. They would have a new monthly payment of $19.58. Okay, but they now have an additional asset that they purchased using some of their primary residence equity. Okay, scrolling down here at a 30-year outlook, okay, this would be the home value, the value of that investment property in 30 years. That's using a 4% property appreciation rate. In California, where I reside, over the last 40 years, the property appreciation rate is north of 5%, even through the housing crisis. Okay, during that time, that homeowner would have paid $705,000 in interest and then principal, paying off that mortgage, but they would have a $2.1 million asset that's free and clear with renters, with tenants, we're assuming, all derived from a $200,000 investment 30 years earlier using primary residence equity. Okay, so I'm sure this video is very thought-provoking for those watching it. Again, full disclaimer, not one size fits all, and age, current assets, all kinds of things factor into what the best approach can be. But the fact of the matter is there's a lot of folks with a lot of equity and rates are still very low, and there's a lot of very impactful decisions that can be made as a result of using that equity in a positive way to create long-term investments and to create more wealth, more financial flexibility, and more freedom for your later years in life. So I hope this was helpful. As always, we are happy to look at your specific scenario. Even if you have questions, comments, concerns over what you just watched, I am available to be reached, and we look forward to chatting with you, and we'll talk to you soon. Thanks.